Hi there. I'm really excited about today's lesson, this strategy, which we call the purchase pivot. And it really leads up to the options that people might want to think about when they're making a purchase transaction and so forth. So let's get right into it, right? So it's really a strategic approach to optimizing all the funds you have available, right? There's down payment money, there's money set aside for closing costs. And how do you balance these things to sort of maximize and enhance your cash flow and build long-term net worth? Right. So kind of the problem is that people save money over many times for years and years and years, and they really believe that the interest rate is the main factor in sort of making this decision. Large down payments do reduce. A larger down payment does reduce monthly payments, but also reduces your liquidity. Lower down payments increase the payment, but also increase liquidity. Right. So how do we balance these things? Inflation doesn't come into play oftentimes for most people. There's missed opportunities, and most lenders are really not skilled at presenting or even thinking through many different options that a consumer might have around debt and cash flow. And so most of these decisions are made in a short-term basis and really consider long-term kind of growth. What's the kind of solution to this? Well, the opportunity first. So the opportunity is what we do, right? So with the advice of a good liability advisor, the consumer is going to find different options. They might find flexibility. They might understand more about inflation. In our case, we discuss things like product payment availability. We teach about a mortgage side fund, how that might work, which is a whole lesson into and of itself. Then how to work with other professionals to sort of, kind of think through all this. So the solution really is the purchase pivot, right? And it's just, again, you're starting someplace. You're thinking about, this is what I want to do. I want to put down 25%. I want to get the lowest possible payment, which is great. That could work for anybody. But we're going to give you some other options to think about and to see if there's a different thought pattern that might come in to be, because we are also talking about repaying smart and how you can pivot and keeping flexibility. So really approach that balances down payment, current and future home equity growth, safety and liquidity, which are really key financial planning concepts. And then collaborating with other professionals to sort of, manage investments and so forth. So how does it work? Ultimately, we're going to illustrate different cash flow with different down payment options, collaborate and model out hypothetical growth of mortgage side funds, analyze different rate buy down options that affect your cash flow, discuss rates over time. Rates are very fluid. At the time of this recording, they're higher than they've been traditionally, but they're probably heading down the other direction at some point. And then discuss inflation. And I'm just going to quickly touch on inflation, because inflation, once you fix a mortgage payment, it gets easier over time. The reality is your income continues to go up, your assets go up over time. So inflation erodes the cost of mortgage debt if it's fixed, which is a good thing. And then safety, liquidity, and rate of return are prioritized. And then when a side fund makes sense, we sort of look at that. So this case study, the client's buying a $450,000 house. They have about $97,000 between cash and a 401k loans. They want to put down 20%. They want a very low payment, and they're pretty conservative. In this case, the family is pushing other options and to make large down payments get a low rate. When I asked the client in this case, what's the most important thing and why do you want to put down a large down payment? The answer was, because we want to have flexibility in our cash flow, and we want to be able to start saving again, because it took us a long time to save this money. So I think that's really enlightening, right? So put more money in to reduce your liquidity in order to be able to build your liquidity again. So the first-time home buyer, they have a child with another one on the way, and so forth. So we present options at 5%, 10%, 20% down. We discuss the importance of liquidity, especially with a young growing family. We discuss different buy down options, which is its own lesson. Teaching about recasting and refinance options that might come up later on, and discussing a mortgage set-aside account and so forth. At the end of the day, the client opted for a 5% down with a 1-1 buy down, meaning they buy down the rate by 1% for the first 2 years. It provides them great flexibility, but better cash flow today. And they put the money into the side fund, which could grow kind of over time to be used for either recast if rates never come down, cashing in if they want to put money back into the property and other financial goals. So just looking at these numbers quickly, we compare a 20% down, a 10% down, and a 5% down. Here's the amount of cash needed for the transaction: $100,000 versus $56,000 versus $40,000. The cash flow difference in this case is 382 between 20% down and 10% down, and 273 between the 20% down. And the reason it's lower again is because they bought down the rate with an additional expense here to do that, basically prepaying the mortgage over time. So that's why there's less money in. So what do we do with that money is we put the money to the side. Here's a side fund, and we pull the money out of that account. So in other words, the cash flow is the same as option number one, but in this case, at 10% or 5% down, the money goes into a mortgage side fund. We pull the money from it over time in order to make the payment the same as if it was 20% down. You'll see down here what the cash flow balance is after 3 years. So $37,000, $63,000, there's still good liquidity for a young family. The overall cost difference is not significant over a 3-year period. And then we also use some other calculators to sort of explain how this all might work and what the value of the money is kind of over time. So that is the purchase pivot. I think it's a pretty cool kind of situation, and we'll be doing further lessons on this down the road. So thanks very much, and we hope to chat with you at some point about the purchase pivot. Thank you.